All right, let's dive in. Today, we're going to put on our detective hats and solve one of the biggest mysteries in the world of investing, figuring out if a stock is a total bargain or, a potential bust. It really all comes down to a thing called valuation. So here's the question, right? The one every single one of us asks. You find a company you think is great, but how on earth do you know if you're paying a fair price for it? Nailing the answer to this is pretty much the key to smart investing. Okay, so every good investigation starts with a first clue. And for us, that's the most famous one out there, the price to earnings ratio, or PE ratio. Think of it as the go-to metric for a quick check. It basically tells you how much you're paying for every single rupee the company makes in a year. To make this super simple, picture this. There's a little shop down the street, and it makes exactly 1 rupee in profit every year. Now, if you went and bought that shop for 33 rupees, well, you'd be paying 33 times its annual earnings. That's exactly what a PE ratio of 33 means. And just like that, we've hit our first wall. So is 33 a lot? Is it a little? Is it a good deal, a bad deal? See, the PE ratio gives us a number, but it doesn't really give us any context to judge it by. It's a clue, for sure, but it's definitely not the whole story. So what's the missing piece of the puzzle? It's one word: growth. Think about it. Paying a high price might be totally worth it if that little shop is about to start making 2 rupees next year, and then 4 the year after that. Growth is the context we were missing. This is where we bring in a more advanced tool for our detective kit, the PEG ratio. And this little formula is kinda brilliant. It takes our first clue, the PE, and it divides it by how fast the company's profits are growing. So it directly connects the price you pay to the growth you get. So what's a good number for the PEG ratio? Well, the magic number is 1. If you see a PEG ratio that's hovering around 1, it suggests the stock's price is pretty well balanced with its growth. Now, if it's way below 1, hey, you might have just stumbled on an undervalued gem. But if it's much higher than 1, that could be a red flag that the stock is overpriced. But of course, it's not always that simple. This is where the plot really thickens. Let's look at Godrej Consumer. If we use its 5-year growth rate, we get a PEG of 1.3, which hints that it's a little overvalued. But if we use the more recent 3-year growth rate, the PEG is less than 1, which screams fairly valued. So, what's going on here? Which one do we believe? And just to make things even more interesting, look at Godrej Consumer. Based on its 5-year growth, the PEG is about 1.1. Looks okay, right? Fairly valued. But then you look at the 3-year growth and the PEG shoots up to 2.0. That's a huge red flag for being expensive. This is getting confusing. Our clues seem to be contradicting each other. So how do we crack this case? Well, here's the secret. You look at the most recent 1-year trend. You have to ask, is the growth speeding up or slowing down? With Godrej, growth was actually accelerating, which made the more recent 3-year number more reliable. For Godrej, growth was slowing down, so using that lower 3-year growth rate was the more realistic choice. The latest trend tells you which clue to trust. But hold on, our investigation isn't over yet. Any good detective knows you have to follow the money. You see, the reported earnings that we've been using, well, they can be a bit misleading. Companies can report a sale even if they haven't gotten the cash for it yet. And that's why you always hear that famous saying, profit is an opinion, but cash is a fact. And that brings us to an even more powerful tool, the price to cash flow ratio. Instead of looking at reported earnings, this one compares the stock price to the actual hard cash the business is generating. This is way harder to fudge on the accounting, and it gives us a much truer picture of a company's health. Okay, check this out. Let's look at another comparison. Godrej Consumer has a price to cash flow ratio of 11, and another company, Jyoti Labs, has a ratio of 12. I mean, those prices are incredibly close. So it begs the question, for almost the exact same price, what kind of business are you actually getting? So on one hand, with Godrej Consumer, for price of 11 times its cash flow, you're getting ownership in these 2 main brands, Godrej Almond Drops and No Marks Cream. These are the assets that are generating that cash. Now, on the other hand, for just a tiny bit more, a price of 12 times cash flow, you get this whole collection, a much bigger, more diversified portfolio of brands you probably know, like Ujala, Maxo, Prill, and a bunch more. And this is where you, the investor, the detective, have to step in. This is the final step. The numbers are telling you the prices are basically the same, but it's your job to look past the spreadsheet and decide which one of these businesses, which collection of brands do you think has a brighter future? So let's recap our whole detective process. It's a clear 4-step playbook. First, you start with the P/E ratio as your initial clue. Second, you refine that with the PEG ratio to bring in the all-important context of growth. Third, you verify everything by following the real money with the price-to-cash flow ratio. And finally, you combine all that data with your own judgment about the business itself. That's how you build a solid case. And that pretty much wraps up our investigation for today. We've uncovered the tools you need to demystify valuation. So now the real question is for you. It's your turn to be the detective. Take a look at the stocks you own through this new lens. Analyze all the clues and ask yourself, what story is your portfolio really telling you?